Yeah, one thing you need to understand as per adjusted present value is that it's similar to NPV, but it's more technical. Adjusted present value is more technical than NPV. So just pay attention to the way I'll be dishing out the concepts of adjusted present value. No matter how complex is the question, no matter how voluminous is the question, once you understand the underlying procedures, you'll be good to go. You will solve the question the way it is expected of you. So just take your time, understand the procedures, and also so that when you see a question, you'll be able to tackle it. All right? So please kindly mute yourself. So let's start from there. So what do you understand by adjusted present value? What is adjusted present value? The adjusted present value is a technique designed principally to appraise a project where financial risk or debt equity proportion of a company is expected to change significantly as a result of undertaking a project. I check it again. The APV is a technique designed principally to appraise a project where the financial risk or debt equity proportion of a company is expected to change significantly as a result of undertaking a project. It is a technique that is used whereby the cash flow from operation is separated from the cash flow from financing, and each of them is now appraised independently. So generally the cash flow from operation represents the base case NPV. Of course, the normal thing you do when you want to calculate your NPV. So that is the base case NPV. When you talk about base case NPV, it assumes that the company is only financed with equity. Okay, there's nothing like debt. So that's base case NPV. Then the financing part of APV is the major sources of financing for the company. The financing can arise through subsidized loan or debts. Okay, company can borrow money for the purpose of the project. So we want to determine what is the present value from the financing aspects of the project. So you now marry the two together. That is what we give you APV. Now, APV and then the net present value are similar. The same way examiner will set the question under APV is the same way the examiner will do under the net present value calculation. Technically and distinctively, the only thing that that separates or that makes adjusted present value slightly different from NPV is if in the question you are given issue cost or subsidized loan. I repeat, the adjusted present value and the net present value are similar in terms of calculation and the way examiner will structure the question. However, what makes APV to be distinct from NPV is if in the question you are given issue cost or subsidized loan. This is because the net present value technique does not consider itself with issue cost or subsidized loan. So if in the question you see anything like issue cost or subsidized loan, and you don't need anybody to tell you that you're supposed to use adjusted present value to appraise the project. Okay? Now, how do you then calculate adjusted present value? There are 4 procedures you are supposed to carry out whenever you want to calculate adjusted present value. So let's do it this way. Let's forget about what you have in this material. Okay, let's forget about what you have in this material. So let me explain to you in details what you need to do as far as APV is concerned. So you follow me the way I'll be dishing it out to you step by step. Then thereafter, we are going to have illustration. Let me stop sharing this, then I'll move to the working notes. So when you want to calculate adjusted present value, like I said, there are 4 procedures you are supposed to carry out. The first step of calculating APV is to calculate base case NPV. Step 2, calculate present value of financing effects. Cash flow. Step 3, you calculate adjusted present value. Estimate or determine adjusted present value. Then step 4, you advise. So these are the 4 procedures you need to carry out whenever you want to calculate adjusted present value. However, it would have been very easy for us if we can just calculate APV, base case NPV, just go to the question and pick some numbers, maybe 1 or 2 numbers, add them together and get base case NPV. Or for the PV of financing effects, just do 1 or 2 abracadabra and you get it. All of these things have their own procedure. Each of them have their own procedure. So let's break it down one after the other. So when you want to calculate base case NPV, so calculating base case NPV. In doing this, there are some procedures you are supposed to carry out. Remember what I said. The adjusted present value is a technique designed principally to appraise a project, whereby the cash flow from operation is separated from the cash flow from financing, and each is appraised independently. The cash flow from operation represents the normal NPV you are familiar with. All right? Then you now have the cash flow from financing. Marry the 2 of them together to give you the adjusted present value. Therefore, when you want to calculate base case NPV, it is assumed that the company is solely financed with equity. That is, there is no debt. Therefore, if I want to calculate base case NPV, what are you supposed to do? The first step for calculating base case NPV is to determine all relevant cash flow or determine net cash flow. Step 1, determine net cash flow. So the normal thing you do when you want to determine net cash flow in your NPV calculation is the same thing you are going to do here. For example, you are going to consider anything if in the question you have sales value, you have variable cost, you have attributable or specific fixed cost. Okay, so you have scrap value. In the question, there is inflation, there is taxation. So all those normal things you do, in fact, as far as the NPV is concerned, are the things you are going to do here as well. So when you are calculating your base case NPV, just know that you want to calculate the normal NPV. So you go to the question, are you given selling price? If yes, is there any inflation on selling price? If yes, then you inflate, you multiply the number of units you get your sales. Are you given variable costs? If yes, is there any inflation rate on variable costs? You go and inflate, you multiply with unit produced, you go and post. All those things you normally do is the same thing you are going to do when you want to calculate your net cash flow, calculating under the base case NPV. Then step 2 is to calculate cost of equity on gear. Calculate cost of equity on gear. KEU. Remember, I said that the base case NPV is assumed that the company is solely financed with equity. Therefore, all this, your cash flow in step one, the net cash flow in step one is assumed that those cash flow will be inflated using the cost of equity on gear. Cost of equity on gear is a cost of equity that does not include anything like debts. There's no financial, there's nothing like debt in the cost of equity on gear. Therefore, how do you then calculate your cost of equity on gear? There are three ways examiner can test you when you want to calculate cost of equity on gear. So like I said, calculate cost of equity on gear using any of the following. Using any of the following. So like I said, there are three ways examiner can test that. There are three ways you can calculate your cost of equity on gear. If in the question you are given, let me use Roman figure. If in the question you are given beta of a proxy, okay? If beta of a proxy is given, then there are three procedures you are supposed to carry out. The first procedure is to identify the proxy beta. Identify proxy beta. Step two, ungear the beta. Ungear the beta if gear. Then step three, calculates cost of equity on gear. Or let me change that. Calculate capping, which is cost of equity on gear. So these are the three procedures you are going to carry out if you are given proxy of a beta. So when you want to calculate your cost of equity on gear, given proxy of a beta of a proxy, then of course we are going to identify the beta in the question. You ungear the beta if it is geared, then you calculate cost of equity on gear, representing capping. All right. So these are all the formulas that you are going to need to ungear. You know the formula for calculating capping. All of this we have done it under project specific cost of capital. It's the same thing. Then Roman figure number 2. If cost of equity of a proxy is given, okay, if cost of equity of a proxy is given, then you are supposed to use the formula, the Miller and the cost of equity designed by Miller and Modigliani. Remember, when we did cost of capital, I explained that there are three methods of calculating cost of equity. One is to use dividend valuation model. When you are given dividend information, that means you are supposed to use dividend valuation model. 2, you can use capital pricing model to calculate your cost of equity. Then 3, you use Miller and Modigliani formula. And I told you when we get to adjusted present value, we are going to use the formula of Miller and Modigliani for calculating cost of equity. Therefore, according to Miller and Modigliani, cost of equity of a gear is equal to cost of equity on gear plus, open a bracket, cost of equity on gear minus cost of debt, or multiplied by debt value into 1 minus tax divided by equity value. So this is the formula of Miller and Modigliani for calculating cost of equity. KEG is the cost of equity of a gear company. KEU is the cost of equity on gear, which you are looking for. This KEG will be given to you. So KEU, cost of equity on gear, will not be given. That's what you want to calculate for. That's the subject of the formula. Then KD is the cost of debt, the interest rate or the coupon rate. D is the debt value of the proxy. E is the equity of the proxy. Then T is the tax rate. So this is the formula you are going to use when you want to calculate cost of equity on gear using Miller and Modigliani formula. Okay. Is given. If cost of equity of a proxy is given, use Miller and Modigliani. Use Miller and Modigliani formula as shown below. Okay, so that's that. Then finally, another way you can calculate your cost of equity on gear is that if you are given work of gear, work of a gear company, of a proxy company. So if work of a proxy is given, then in this case, the following formula should be used. Okay, so if work of a proxy is given, then work of a gear, is equal to work of on gear multiplied by 1 minus debt value multiplied by tax divided by equity plus debt value of the proxy company. Okay, so that's that. This is the formula you are supposed to use to calculate work of on gear company. This work of on gear is something as cost of equity on gear. All right. So note the work of on gear equal to cost of equity on gear. So these are the three ways in which you can calculate cost of equity on either of the three will happen on the day of your exam when you have adjusted present value. One of the three is what you are going to calculate for. Okay, but that's why you have, because you don't know which is which. That's why you have to ensure that you memorize, you understand the procedures I'm giving you right now. All right. So once you have the cost of equity computed, you now move to step 3, which is to calculate present value. 3, calculates present value. So to get the present value, of course, calculate present value by multiplying the net cash flow in step 1 above with the cost of equity on gear in step 2, or with the discount factor, using the cost of equity on gear in step 2 above. So the normal way you calculate your present value. So in as much as you've already computed the cost of equity on gear, just go ahead and find the discount factor, then multiply with the net cash flow. All right. Then step 4, you calculate base case NPV. Calculate base case net present value. So this represents the difference. The difference between the present value of cash inflow and pressure flow. All right. So these are the procedures you are going to carry out whenever you want to calculate base case NPV. So once you are done calculating your base case NPV, you keep it on one side. Then you now go to the present value of financing effect, cash flow. So let me show you now how to calculate the present value of financing effects. Okay, how do you calculate the present value of financing effects? Number B step of calculating APV. So I would then say calculating the PV of financing effects, cash flow. So how do you do this? To calculate the PV of financing effects, there are 3 stages that you are going to carry out. But first thing first, before you move to the 3 stages, there are 2 certain things that you must establish as initial before you start calculating the PV of financing effects. The first thing is that you want to know, okay? You want to know which discount rates you must establish from the beginning. The discount rate will be used to discount the cash flow arising from financing, okay? Do you want to use cost of borrowing or you want to use risk-free rate of return? Because the Miller and Modigliani that propounded the adjusted present value failed to tell us the cost of capital or discount rates to be used for financing effect cash flow. Therefore, you are at liberty to either assume cost of borrowing or the risk-free rate of return. Whichever of the two that you use is what examiner will mark for you. But at all time, always use the cost of borrowing, because cost of borrowing will always be higher than the risk-free rate of return. All right. So you need to ascertain the discount rates to be used for financing effects, cash flows. For this purpose, okay, for this purpose, you can either assume cost of borrowing or risk-free rate of return. Okay, so whichever of the two, you have to state your assumption. Whichever of the two that you assume, you state your assumption. Let the examiner know your position. Then the second thing you need to do before you start calculating the PV of financing effect is that you need to ascertain from the beginning for the cash flow arising from subsidized loan and the tax saved on the on interest. Do you want to use gross finance required or you want to use the net finance required? So whichever of the two, you also need to state your assumption. So ascertain whether gross finance required, whether the net finance required or gross finance required. Okay, ascertain whether net finance required or gross finance required should be used. For the cash flows arising from subsidized loan or saved on interest. Okay, so once you have these two sorted out from the beginning, then every other one is straightforward, no issue. You then begin the calculation of your PV of financing effects. So let me pick it as another step. When you want to calculate the PV of financing effects, there are three procedures. The first procedure is to calculate present value of issue costs. Then step 2, you calculate the PV of net subsidy. Then step 3, you calculate the PV of of net interest. So when you add the three of them together, that will give you the PV of financing effect. So the first item, let's call this one 3A. Let's call this one 3A. So you calculate PV of financing. So calculate PV of issue cost. Now, before we talk about calculating PV of issue cost, you must understand the meaning of issue cost. What are those? What do you understand by issue cost? Issue costs are costs associated with underwriting and raising debt and equity capital. When a company wants to raise capital, there are some costs associated with raising those capital. For example, if a company is going for initial public offer, the company will need to incur costs before the funds will be released from the public, before public will subscribe to the company's shares. For example, some examples of issue costs include marketing expenses or advertising. You know, when a company wants to raise capital, like our banks in Nigeria are currently doing, that offer, okay, on social media, anywhere. So they are going to pay money for that marketing activities. So it's part of issue cost. Before the company receive the money from the public, before the public subscribe for the shares of the company, those marketing expenses would have been incurred. So that is one of the examples of issue cost. Another one is that when the company is raising the funds, the company cannot just talk to the public directly. There is an intermediary, which is investment banker. So it is investment banker stand on behalf of the company to raise the funds. So the investment banking fee, the company is expected to pay investment banking fee to the investors. So it's part of the cost, it's part of the issue cost of raising the capital. The third one is audit fee. So the financial statement of the company will need to be audited to be sure that what the company is claiming to have achieved in the previous year. Then not only that, there will be legal fee, legal expenses. Okay, it's also part of issue cost. In addition to it, there will be registration fee that will be paid to the Securities and Exchange Commission. These are some of the expenses, and these are some of the issue costs. So if that is the case, now that you know what issue costs are, how do you determine the present value of issue cost? Now, there are two elements of issue cost. Remember, I mentioned to you that issue costs are costs associated with underwriting and raising debt and equity capital. So there are two elements to issue costs. If you are given the two in a question, we have the debt element, we also have equity element. So at the beginning of the project, when the company is raising the money, all these expenses will be incurred. Therefore, you are going to separate the debt, the portion of the debt is separated from the portion of the equity. However, in addition to that, that means in year 0, you are going to have two elements: the PV of issue cost amount on debt plus the PV of issue cost amount on equity. You keep it on one side. However, when a company raises debt, when a company raises debt capital, so the company is expected to claim or is expected to claim tax relief or tax benefits on the issue cost amount on debts in year 1 only. So technically, what I'm trying to tell you is that when you want to calculate PV of issue costs, so there are 3 stages. You are going to carry out 3 or 4 stages. The first stage is to determine. Okay, there's something I've omitted here, which has to do with net finance required or gross finance required. How do you determine the net finance required and the okay, let me come back for this one. So that will even afford me the opportunity. So I will come back to the issue cost, the format for calculating the present value of issue cost. So let me quickly complete this. So for example, the net finance required, it is assumed that the initial outlay and the working capital of the company will be financed through the net finance, represent the net finance required. So this is equal to initial outlay plus the working capital. So this will be at the beginning. So it is assumed that the subsequent working capital will be financed through the internally generated funds for the company. Then for the gross finance required will be equal to the net finance required divided by 1 minus issue cost rates. Okay, 1 minus issue cost rates. So that's for that. So you need to ascertain whether you want to use the net finance required for subsidized loan and then tax saved on interest, or you want to use the gross finance required. At all time, always use the gross finance required, except the examiner says otherwise. Okay. So let's go back to.
Sorry. Hello.
Yes, who's speaking?
Is that Ayodele? Is that gross finance required? It is net finance required over 1 minus 1.
1 minus issue cost rates. They are going to give the percentage of issue cost. It could be 3%, it could be 2%, it could be 4%, it could be 5%, whatever the percentage of issue cost. So for you to gross it up, all you need to do is to divide the net finance required. And I said your net finance required is the initial outlay plus working capital. So you divide it with 1 minus issue cost rates. All right. So for the 3A, so you calculate the PV of issue costs. So I've already explained this, so let me just show you the format you are supposed to use. So the first thing you are going to do when you want to calculate the PV of issue cost is to determine the issue cost amount. That's the first step. Determine the issue cost amount. Let me write that in full. Issue cost amount. ICA. So the issue cost amount is equal to issue cost rates multiplied by gross finance required. So that will give you the issue cost amount. Okay, that will give you the issue cost amount. So once this is done, then you now move to step 2. Step 2 is to calculate PV of issue cost in year 0. Calculate PV of issue cost amount in year 0. So like I told you earlier on, the APV is more technical than the normal net present value. So because there are 2 stages for adjusted present value. So calculate the PV of issue cost amounts. In this case, I will go to the question. If there is issue cost on debt, I want to know whether there is issue cost on debt and equity. So if you have the 2, so just go there and calculate. Therefore, on the debt, issue costs on the debt will be equal to issue cost amount on the debt, that is the net finance required on the debt divided by 1 minus issue cost, because the rate of the debt will be, the rate on issue cost on debt will be different from the rate on issue cost on the subsidized, sorry, on equity. So just go ahead and calculate and divide the net finance required over, once you have your gross finance required, you get the proportion of debt, you get the proportion of equity that's given to you. So then you multiply. So one issue cost amount on debt multiplied by the discount factor, sorry, multiplied by issue cost rates. Okay. I've already, yeah. So the issue cost, sorry, I multiply by the discount factor, multiply by the discount factor at year 0. Okay, so that will give you the present value of the issue cost in year 0. So you are given the debt, sorry, the equity as well. So the issue cost amount on equity multiplied by discount factor at year 0. Again, anything that has to do with issue cost, so it has to be in brackets. So you keep these two on one side. The last thing you are going to do is to determine the tax saved on issue cost amount. Okay, tax saved, you consider the tax saved on issue cost amount on the debt. Okay, tax saved is the same thing as tax relieved on the debt. How do you do this? Simple. Just pick the issue cost amounts on debt multiplied by discount factor at year 1 only. Okay, year 1 only. So you only calculate tax saved on issue cost amount on debt. There's nothing like tax saved on equity. So it's only on debt. So it's a cash inflow. So at the end of the day, you add up the present value or the 3 present value, they are going to have a negative. So this will represent the PV of issue cost. So you keep it on one side, you go and do the remaining ones. So these are the formats you are going to use whenever you want to calculate the PV of issue cost. Then 3B, I told you there are 3 stages of calculating present value of financing effect. So 3B, okay, so you calculate PV of net subsidy. Calculate PV of net subsidy. To do this, there are 4 stages. There are 4 procedures you are supposed to carry out. Step 1, determine the amount attributable to subsidy. Step 1, determine the amount attributable to subsidy. How do you do this? Very simple. So subsidy amounts, which is SA, amount attributable to subsidy is SA. Therefore, SA is equal to the gross finance required multiplied by proportion of subsidy. Proportion of subsidy or okay, that will give the subsidy amount. The proportion of, say for example, out of the gross finance required of 100,000 naira, examiner may tell you that 60%, 70%, 30%, 40% is attributable to subsidy or subsidized loan. So that is the proportion. Once you are given the proportion, just multiply the proportion with the gross finance required you have computed previously. That will give you the subsidy amount. Step 2. Step 2 is to calculate savings on subsidy. Step 2, calculate savings on subsidy in percentage, SOS in percentage. All right. Saving, remember, anything that is subsidized is usually cheaper than the market price. Okay. So the difference between the market price and the amount, and the amount of the subsidy will represent the savings. So in this case, I would then say savings on subsidy in percentage will be calculated as the normal borrowing rate minus interest rate on subsidized loan. So the difference between the interest rate on normal borrowing is when you go to your bank, the interest rate you pay on the loan you borrow from the bank or from the investor. So minus the interest rate the company will pay through the subsidized loan. The difference represents savings on subsidy. Then step 3, you need to calculate net subsidy. Okay, calculate net subsidy, NS. How do you calculate net subsidy? NS is calculated as subsidy amount you have in step 1 multiplied by savings on subsidy in percentage, okay, then multiply by 1 minus tax rates, okay, multiply by 1 minus tax rates. So that will give you the net subsidy. Then finally, step 4, you need to calculate the PV. Calculate the PV of subsidized loan, PV of net subsidy. So these are the 4 procedures. How do you get the PV of net subsidy? So the PV will then be equal to the net subsidy multiplied by annuity factor. Net subsidy multiplied by annuity. Let me write that. Annuity factor. AF. Remember, I told you in step 1 that you need to establish from the beginning whether you want to use cost of borrowing or risk-free rate of return to discount the cash flow arising from financing. So all this calculation of PV that you have in each of the steps, so you would have determined from the beginning whether you want to use cost of borrowing or the risk-free rate of return. So just go ahead in this step 4 for calculating PV or net subsidy. So after you have determined the net subsidy, just multiply with the annuity factor. So once you do that, you keep it on one side and go on to do the last one, which is 3C now. For the 3C, you calculate PV of tax saved on interest. The interest on subsidized loan and the interest on the normal borrowing. So you need to calculate the present value, the tax saved on them. To do this, there are 3 stages you are going to carry out. The first stage is to determine is to accumulate all interest elements. Accumulate all interest elements. Okay, that's the first thing you need to do. That is to get the interest on normal borrowing. For example, for the normal borrowing, what's the interest expense? So you are going to multiply the gross finance required, gross finance required, multiplied by the percentage of normal borrowing, multiplied by percentage of normal borrowing. So if you say that subsidized loan is 40% of the gross finance required, it means that the balance of 60% is through normal borrowing. If you say subsidized loan is about 80%, it means that the balance of 20% is normal borrowing. So you are going to multiply the proportion of the normal borrowing with the gross finance required, as well as the interest rates on the normal borrowing, which is the normal borrowing rate. Let me rewrite this so that you can accommodate that space. Okay. So I have interest on normal borrowing. Interest on normal borrowing, which is equal to the gross finance required multiplied by percentage of normal borrowing multiplied by interest multiplied by normal borrowing rates, the interest rate on the normal borrowing. So normal borrowing rate. You keep this on one side. Then you take the other one, which is the interest on subsidy. So the interest on subsidy, again, is the gross finance required. You've already done this under subsidized loan. Okay? Gross finance required multiplied by the percentage of subsidy. They multiply by interest rate on subsidized loan. So you add the two of them together. That will give you the total interest. Total interest. So that total interest, that's your first step. You accumulate all interest elements. Then step 2, you calculate tax saved on interest. Calculate tax saved on interest. How do you do this? Very simple. So I will then say tax saved is equal to the total interest in step 1 multiplied by company tax rates. Multiplied by company tax rates. Then finally, calculate the PV. Calculate the PV of tax saved on interest. So just multiply PV will be equal to the tax saved multiplied by annuity factor. So these are the procedures you are going to carry out whenever you want to calculate the PV of tax saved on interest. Then finally, you then calculate the PV of financing effect cash flow. Okay, calculate the PV. That's step 4. Calculate the PV of financing effects cash flow. So all your calculation previously as above. So this is the time for you to now put them down. I will then say PV of issue cost. Come and post, certainly to be in brackets. I will add PV of net subsidy. It's a cash inflow. Then finally, PV of tax saved on interest. It's also cash inflow. So you had everything together. It could be positive or negative. So this will represent the PV of financing effects. Okay, that's the PV of financing effect cash flow. So once you have the PV of financing effect cash flow, that will take us to number C. Number C of the general steps is to calculate APV. Now, step 1 is to calculate base case NPV. Step 2 is to calculate PV of financing effect cash flow. Then step 3 is to calculate adjusted present value. So calculate adjusted present value. So the adjusted present value represents the difference between the base case NPV. So the base case NPV plus minus whatever you have calculated as base case NPV, put it here, then plus minus the PV of financing effects cash flow. So this could be positive or negative. So at the end of the day, you have your APV, which also could be positive or negative. This is your adjusted present value. Finally, step 4, which is D now. Am I using a small letter or capital letter? Okay, small letter. This case NPV, small letter A. Yeah, that's it. So finally, you need to calculate or you need to advise. That's step 4. Number D, advice. I did not put those ones in brackets. So advice on the acceptability of the project. So the decision rule is that just the same way you have decision rule of NPV. So if APV is positive, accept the project. But if otherwise, if APV is negative, you reject. So that's that. So these are the procedures for calculating adjusted present value. So it's not broken down like this in any other material. So I took my time to explain it to you now. Please. The last time ICANN tested APV was 2019. Ever since then, we've been expecting it, and ICANN has not tried it again. You never can tell what will happen this coming diet. And then, of course, if APV is going to come out, usually in all those business analysis, just like you have in your capital budgeting, it's usually on November diet. If ICANN will test it, it should be in November diet. So this diet, I don't know whether it's going to be APV, NPV, internal rate of return, cost of capital, or whatever that will come as the compulsory question. So, but it's part of your syllabus and you have to know them. All right. So that's that. At this point, the only thing we need to do now is to solve question. And we are not going to solve more than one question because it takes time. Question on APV is big, and at the same time, it takes time to solve. So I can't do more than one. Even in physical class, it's the same one question. It takes time. Okay? So, yes. Let's have an illustration. I will stop sharing this and move to the note, the question material. So you can go back to the material and read more of what we have discussed so far. In my golden book, you see more explanation there. There are about, I have several worked examples, practical exam questions in the golden book, which you can master on your own. The way it is treated, using net finance required or using gross finance required. That was a particular question I demonstrated the two, so that whichever one that is more convenient for you. But like I said, at all time, always use the gross finance required, okay? Examiner will not tell you to use gross finance or net finance, but at all time, always use the the gross finance required. So this illustration number 1 is ACCA. Okay, so let's solve this ICANN question that was tested in 2019. All right, so I need somebody to read it for us. Somebody should please read. Who will help us? Yes. Are you guys there? Who is helping us?
Okay.
All right, Jide. Thank you.
Yeah. Alcantara Limited is an unlisted company based in Akure, Nigeria. Over the years, the company has been producing and selling agricultural support foods. AL is now considering the production and sale of yam powders. Although this is a completely new venture for AL, it will be in addition to the company's core business. AL's director plans to develop the project for a period of 4 years and then sell it for 24 million to a group of young investors. The government is excited about the project and has offered AL a subsidized loan of up to 80% of the investment funds needed at the beginning of the project, at a rate of 200 basis points below AL's borrowing rate. Currently, AL can borrow at 300 basis points above the 5-year government debt yield rate. You can help me scroll up, sir. A feasibility study commissioned by the directors at a cost of 5 billion has produced the following information. The company can buy an existing suitable factory at a cost of 16.5 million payable now. 4.5 million is required now to buy and install the necessary plants and machinery. The company will produce and sell 1,300 units in the first year. Unit sales will grow by 40% in each of the next 2 years before falling to an annual growth rate of 5% for the final year. Unit selling price for the first year will be 3,750 naira, but this will increase by 3% per year thereafter. In the first year, total variable cost units will be 1,800, but this will increase by 8% per year thereafter. In the first year, the fixed overhead cost will be 3.75 million, of which 60% are centrally allocated overheads. The fixed overhead will increase by 5% per year after the first year. AL will require working capital of 15% for the anticipated sales revenue for the year at the beginning of each year. The working capital is expected to be released at the end of the 4th year when the project is sold. AL's tax rate is 25% per year on taxable profits. Tax is payable in the same year as when the profits are earned. Tax allowable depreciation is available on the plant and machinery on a straight line basis. It is anticipated that the value attributable to the plant and machinery after 4 years is 600,000 of the price at which the project is sold. No tax allowable depreciation is available on the factory. AL uses 12% as its discount rate for new projects, but feels that this rate may not be appropriate for this new type of investment. It intends to raise the full amount of funds through debt finance and take advantage of the government's offer of a subsidized loan. Issue costs are 4% of the gross finance required. It can be assumed that the debt capacity available to the company is equivalent to the actual amount of debt finance to be raised for the project. Although no other companies produce yam powders in the country, Cantona PLC produces cassava crushing machines using almost similar technology to that required for yam powder. CL's cost of equity is estimated to be 14% and it pays tax at 28%. CL has 15 million shares in issue, trading at $2.53 each, and 40 million bonds, trading at 94.88 per 100 naira. And the 5-year government debt yield is currently estimated at 4.5% and the market risk premium at 4%. Required. Evaluate on financial grounds whether AL should proceed with the project. B. Discuss the appropriateness of the evaluation method used and explain the assumption made in Part A. Provide examples of ethical issues that might affect capital investment decisions and discuss the importance of such issues for strategic financial management.
Thank you very much, Jide. Yes, that is the question. That is the question. This question was tested in 2019, like I said, when ICAN changed syllabus, newly changed syllabus to whereby the compulsory question then was 40 marks. Then effective 2021, it was reverted to 30%, 30 marks for compulsory question. That's what we still have up to today. So in this question, number A requirement, you are asked to evaluate on financial grounds whether AL should proceed with the project. You can see examiner did not tell you which techniques to use. So you have to evaluate. Remember what I told you under capital budgeting. When you are told to evaluate, advise, or determine the financial viability or assess, you are supposed to use NPV, right? So you can see even in this question, an average student will go ahead and still be using NPV. But when I was explaining to you, and I believe you are not an average student, because I've already explained that APV and NPV are similar. The only difference that makes APV to be unique is if in the question you are given issue cost or subsidized loan. And when Jide was reading this question, he read about issue costs as well as a subsidized loan. So if that is the case, you are supposed to use adjusted present value to appraise the project. You cannot use NPV. It has to be adjusted present value. It is not compulsory that subsidized loan and issue cost must be present in the question. It has to be either of the two. It's either it is subsidized loan or subsidized or issue cost. At times, examiner may want you to calculate APV specifically, then of course, only interest amounts will be available. There will be no subsidized loan, there will be no issue cost, but you are going to have interest in the question. But what is important is that once you see issue cost or subsidized loan, it is clearer. It has to be adjusted present value that will be used to appraise the project. Therefore, to solve this question, there are two stages. The first stage, Oh, sorry, there are 4 stages for you to be able to earn the 28 marks on the A requirement. There are 4 stages. The first stage is to calculate the base case NPV. So your base case NPV will be computed as if the company is only financed with equity. You keep it on one side. Then you then calculate the present value of financing effect cash flow. What's the present value of issue cost? What's the present value of subsidized loan? What's the present value of tax saved on interest? Then, of course, we go to step 3, which is to calculate adjusted present value, which represent the summation of base case NPV as well as a PV of financing effect cash flow. Then you advise, okay, because examiners say evaluate on financial ground whether the company should proceed with the project. So you need to advise. So those are the 4 stages, or those are the 4 procedures that you are going to carry out whenever you want to compute adjusted present value. So let's take it one by one. So I've stopped sharing this and moved to the working notes. Please open to the material at your own hand. Okay, so the first thing we are going to do is to calculate the base case NPV. So let me use this page, and this one accommodates the NPV. Yeah, it should. So I would then say illustration 2. That is Alcantara Limited. Okay, so first thing first is to calculate. Remember what I said, there are 4 stages. You calculate base case NPV, you calculate PV of financing effect cash flow, you calculate the APV, then you advise. Those are the first steps you need to carry out. So first thing first, I want to calculate base case NPV. So I will say calculating base case net present value. Our figures, according to the question, some figures given to us are in millions, some are in full numbers. So we can decide to use, let's use thousands. Our figures will be in thousands. Okay. Then I will go back to the question. What's the useful life of the project? Examiner told us that although this is a completely new venture for AL, it will be in addition to the company's core business. AL's director plans to develop the project for a period of 4 years and sell it for 24 million naira. So the useful life of this project is 4 years. Then how is the company going to pay tax? Is it in the current year or in arrears? So you are told that tax is payable in the same year as when the profits are earned. Therefore, I don't need to stress myself. So I will just come here. I will do year 1 to 4. Create a column for year 0, year 1, year 2, year 3, year 4. Then lastly, create additional column for workings. Okay. So I will go to the question, is there any selling price? Yes, there is selling price. Therefore, I need to go and calculate value for my sales. So let's go and do our workings. I believe this will be okay for NPV, the base case NPV. So let's start our working for base case NPV from here. Hopefully, in case, let's use the half in case anything extends to the second page. So we want to calculate sales value. So let's say this is our working. Let me extend it beyond this for my PV of financing effects. Second page, third page, then let's start workings from here. Okay. So working number 1. So first thing first, year 1, year 2, year 3, then year 4. Working number 1 is units. Examiner told us that. Let's go back to the question where we have number of units. When Jide was reading it, I have already indicated it by the side of the paragraph. We are told in the third bullet point that the company will produce and sell 1,300 units in the first year. Unit sales will grow by 40% in each of the next 2 years before falling to an annual growth rate of 5% for the final year. So the units for the first year is 1,300. Okay. Let's use primary school method. Then this one will be inflation. Okay. So 1,300, 1,300, then 1,300. So because the sales units in the first year is given to us, so you are not going to inflate the first year units. So the second year will be 1.4 raised to power 1, 1.4 raised to power 2. We now told that from year 4, now fall from 1.4 from 40% to 5%. So the inflation of 40% of year 2 of year 3 now fall to 5%. Therefore, I would then say 1.4 raised to power 2. That is what you have in year 3. Then now fall to 5% inflation. That's 1.05. Okay. Therefore, here will be 1,300. Let's say this is A. Then I would then say, bring out the calculator, 1.4 raised to
1,820.
Okay, 1,820. 1,820 multiplied by 1.4 raised to power 2 multiplied by 1.3.
2,548.
2,548. That answer you have in your calculator, 2,548, or whatever you have in the calculator, multiplied by 1.05. What do you get? Yes?
2675.4.
2675. That's it. That's it, because the examiner told you that it's increasing, the sales unit is increasing by 40% before falling to 5%. So in the fourth year, this 1.42, 1.40 raised to power 2 is what you have in year 3. So it has now fallen to 5%. So you are just increasing this number by 5%. That's all. That's what the examiner told you. Then working number 2 now. Please mute. Working number 2 is sales value. Working number 2 is sales value. So there's a selling price. And we are told that the selling price in the first year is 3,750. Unit selling price for the first year it will be 3,750, but this will increase by 3% per year thereafter. So examiner has given us the first year price to be 3,750. Therefore, you carry your calculator, 1.03 multiplied by 3,750 equal, that's 3,863. 3,863. Whatever you have in your calculator multiplied by 1.03 equal 3,978. 3,978. What you have in your calculator multiplied by 1.03 equal 4,098. Here is 4,098. So that's inflated selling price. Let's say this is B. So to get the total sales, remember our sales are in thousands. To get the total sales, you multiply A by B. Okay. Therefore, 1,300 multiplied by 3,750. It says what? 4,875. Okay. The next one. Yes, the next one.
703066.
7031. Then the third year. The third year.
136.
136. So that's the value. That's the sales value. That's the sales value. I'll just go and post. You don't wait until you complete all your workings before you post. So in order for me not to be shifting from pages, let's just go ahead. The third working will be variable cost. In the question, we also have variable cost. So variable cost, I will go back to the question. What's the variable cost? After sales, we are told that in the first year, total variable cost per unit will be 1,800, but this will increase by 8% per year thereafter. So at 8% inflation, the first year price is 1,800. Therefore, 1.08 multiplied by 1.8, that's 1944. Multiplied by 1.08 equal 29, that's 2,100. What you have in your calculator multiplied by 1.08 equal 2267. 2267. So we have inflated the variable cost. The next thing we need to do now is to calculate the total variable cost. Of course, figures in thousand. So let's say this is C. Therefore, A times C. Give it to me. A times C. So I will do the last one. Multiply by 2267.
The first one, 2,340.
Okay. 60, 64. It said 2,640.
340. No, 340.
Okay, 340. Okay.
The second one,
Yep.
3,568.
3,568.
38.
38. Okay, 3,538. Okay. Then year 3.
5351.
5351. So that's that. That's that. Then we go back to the question, am I given specific or attributable fixed costs? You are told that immediately after variable cost, you are told that in the first year, the fixed overhead cost will be 3,750,000, of which 60% are centrally allocated overhead. The fixed overhead will increase by 5% per year after the first year. Again, I don't need to do working for this one. So examiner has told you that out of the 3,750,000 naira fixed overhead, 60% is centrally allocated. It means that the 40% balance is relevant. So let me just do the working since I'm not posting everything now. So working number 4, fixed overhead. Again, on the day of your exam, don't go and be working for this kind of fixed overhead. Just go ahead on the table, multiply it. So fixed overhead at inflation rate of, I think 5%. Yes, 5%. So before that, before you even go to, okay, before you go to inflation, so the fixed overhead, you are told it is 40%. You are taking only 40% of 3,750, which is equal to, what's 40% of 3,750? Multiply by 0.4. That's 1,500. Therefore, the inflation, the fixed overhead at inflation of 5%. So for the first year, it's 1,500. Therefore, 1,500 multiplied by 1.05 equal 1575. 1575 multiplied by 1.05 equal 1654. Okay, and the last one is equal to 1736. So with this, we have inflated the fixed overhead. The 60% portion that is centrally allocated is irrelevant. You ignore it. Okay, that's an apportionment. Then let's move back to the question. Remember, we are following a format. After sales is variable cost, you consider attributable specific fixed cost, you determine your profits. So the next thing we need to do now, just let's go and post our numbers first before we move to whether there is tax saved on capital allowance. So let's go and post. Please, you'll be giving me the numbers for sales, for variable cost and then fixed cost. So all I can see that for the first year sales is 48.75. So let's go and post. 48.75. 4875 7031. I think this is 10 136, then 10 962. 962. Working number 2. Okay. Let me write that. So working number 2, variable cost. The variable cost for the first year, what do you have for the first year? Variable cost.
2340.
2340. Year 2?
3538.
3538. Year 3?
5351.
5351. And then
6064.
6064. Working number 3. Of course, it has to be in brackets. Then we have fixed overhead. For the first year is 15, followed by 1540. Is it 1544 for the second year?
75.
Okay, 1575. Next one. What?
1654.
54. And the last one?
1736.
736. Okay. So let's go back to the question. If we have any other relevant cash flows that we need to consider. All right. Yes, before the bullet points, you are told that a feasibility study commissioned by the directors at a cost of 5 million naira has produced the following information. Feasibility study cost of 5 million naira is a sunk cost because that activity has been completed before the project begins. Remember, cash flow must relate to the future. So the 5 million naira is a sunk cost and therefore irrelevant. So what else? Is there any other cash flow again that we need to consider? Okay, for now, none. Let's move on. So give me the net cash flow, sorry, the profits. Give me the taxable profits.
1035.
Pardon?
1035.
Okay. Yes. Somebody should give me from the last one or the one in the year 3.
Second year.
Yes.
Second year is what?
1918.
1918.
The last year.
Yep.
3162.
3162.
3131, yeah, 3.
3131. So that represents the taxable profit. Immediately after this, you need to pay tax. So tax for the company is at the rate of company tax rate. It's at the rate of 25% and is payable in the same year in which the profits are earned. So 25%. So at 25%. So what's 25% of 1035?
Third year is 783.
Okay. Third year, 783. Okay. Yeah. This is 259. 259. The second year is 290.
1035.
Did you say 290 or 292?
Yeah, right.
1918 multiplied by 0.25. 49, that's a 480. Here is 480. Okay. All right. So, of course, you are paying it. It's a cash outflow. Then after this, consider tax saved on capital allowance. So let's go and do working for tax saved on capital allowance. Working number 5. Tax saved on capital allowance. I will then go to the question, how am I going to claim capital allowance? Did I write it down? Did I note it? No. So let's go to where we have information on capital allowance. Yes, still on the same paragraph where you have the tax rates. You're now told that the tax allowable depreciation is the same thing as capital allowance. So you are told that tax allowable depreciation is available on the plant and the machinery on a straight line basis. It is anticipated that the value attributable to the plant and machinery after 4 years is 600,000 of the price at which the project is sold. No tax allowable depreciation is available on the factory. When you look at the question as given to you, in the first bullet point, you are told that the company can buy an existing suitable factory at a cost of 16.5 million naira payable now. That's initial outlay. Then in the second bullet point, 4.5 million is required now to buy and install the necessary plants and machinery. So when you have 16.5 plus 4.5, that will give you 21 million naira initial outlay. So when you want to calculate your capital allowance, it must be based on the qualifying capital expenditure. The existing factory of 16.5 million naira is not qualified for capital allowance because the owner of the assets, the original owner of the assets of the factory would have been claiming capital allowance and you cannot transfer it. Therefore, the 16.5 million is not qualified for capital allowance. Only the 4.5 million is qualified. And the examiner has already told you this as well by telling you that it is anticipated that no tax allowable depreciation is available on the factory. So, and the tax is paid, capital allowance is claimed on a straight line basis. So I don't need to waste my time. I will just say capital allowance, which is calculated as, capital allowance is calculated as the cost minus the scrap value divided by the useful life of the assets, because examiner has told me it's on a straight line basis. Therefore, the cost of this asset is 4.5 million naira. The scrap value of the asset that is disposed is 600,000. We are told that the project is disposed of at 24 million and as 24 million naira to a young investor, to some young investors. The examiner now told you that the plant and machinery is disposed of at 600,000 naira, which is part of the 24 million naira. So divide by the useful life of 4 years. So what do you have here? 39 divided by 4. That's 975.
Yeah.
Here is 975,000 naira per annum. Okay. So with this, I can then calculate my tax saved. Okay. Tax saved on capital allowance is equal to capital allowance multiplied by company tax rates, which is equal to 975 multiplied by 25% tax rates. So what do you have there? Multiplied by 0.25 equal, that's 244. 244 per annum, 244 million per year. That's what the company will claim. Okay, so in this case, remember, it's 243.75. So 243.75. If you do 244 times 4, that will be over by 1. That will be 976. Therefore, you can make the last one to be equal to 243 instead of 244. So let's go and post. Our tax save is 244 per year. So here is 244. It's a claim. 244, 244, 244, then 243. That will make 975. You can't claim more than the capital allowance allowed. Then, of course, there will be scrap value for the projects. Examiner has told you that the project will be disposed. AS Director, in the second paragraph, you are told that AS Director plans to develop the project for a period of 4 years and then sell it for 24 million naira to a group of young investors. So disposal value or scrap value is 24 million. So this will happen in the final year, 24,000. Our figures are in thousand. Then after scrap value, you should have initial outlay. So our initial outlay is 21,000. How do you arrive at 21,000? We are given the cost of existing factory. That's working number 6. Initial outlay. So the cost of existing factory of 16,500,000 plus the cost of plant and machinery of 4.5 million. This produced 21,000. Okay. Then finally, we're also going to have number 7. We are going to have working capital. Okay. How do we treat the working capital? Examiner has told us that working capital, AHL will require working capital of 15% of the anticipated sales revenue for the year at the beginning of each year. The working capital is expected to be released at the end of the 4th year when the project is sold. So working capital is 15% on the sales revenue. So let's go and do working for that. Year 1, year 2, year 3, year 4, then total working capital. So working capital at 15% on sales. Okay. The sales of year 1, based on our working, is 4875. Therefore, 4875 multiplied by 0.15 equal 731. Working capital in the first year is 731. Then for the second year sales, 0.15 multiplied by the second year sale is 7031. Okay, multiplied by 7031. 31 equal to 1055. Second year is 1055. The third year says, which is 10136. Okay, 10136 multiplied by 0.15 equal 1520. And the last one, which is 10962 multiplied by 15%, 1644. So the highest working capital is 1644. You can see working capital has increased from 731 to 1644. Therefore, we need to find incremental working capital. The first year working capital is 731. So this has increased to 1055 minus 731. That's 324. Again, 1055 has increased to 1520 by 465. 1520 has increased to 1644 by 124. So that's that. So that's the increment. The total working capital we are going to recover is 1644. The rule says that working capital should be treated as cash outflow relevant year. Working capital should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. So year 2, year 3, then year 4, you recover everything. So let's go and post. Okay. 21,000. Working number 6. Then we have working capital. The first year, I think is 735. Can't remember, like 731. Okay, cash outflow. What's the second year working capital?
$324.
Okay. 324, 465. 324. 124. Is it 465? 465. Then 1644. Working number 7. So at this point, we need to get the net cash flow. So what's the net cash flow? Of course, this one is 21731. Give me the net cash flow quickly. So let me do the third year, 31 minus 783 plus 244 minus 465. Here is 2127. 2127.
Last year, 28,258.
28.
258.
258. Okay.
Last year, 696.
696.
Second year, 1558.
1558 or 3.
8.
8. Okay then. So that's the net cash flow. So the next thing we need to do now is to calculate cost of equity on gear. Remember what I told you when you are calculating base case NPV. The first step is to calculate net cash flow, which is what we have done now. The second step is to calculate cost of equity on gear. So let's go and calculate cost of equity. Examiner will never give to you cost of equity on gear. When you are calculating APV, you are the one that will estimate it yourself. So working number 7 now, 8. Working number 8, I want to calculating cost of equity on gear. Okay. All right. So I will then go to the question, how am I going to calculate my cost of equity on gear? Remember, I told you there are 3 ways. If you are given beta of a proxy, so it's either you are given beta of a proxy, you are given cost of equity of a proxy, or you are given WACC of a proxy. You go to where you have proxy information. According to the question, when Jide was reading the question, I noted proxy company. So you are told that although no other companies produce yam pandas in the country, Cantona PLC produces cassava crushing machines using almost similar technology to that required by Yam Panda. For Yam Panda, CS cost of equity is estimated to be 14%. So examiner has given to you the cost of equity of a proxy company. Therefore, you are going to use Miller and Modigliani formula to calculate the cost of equity on gear. So I will then come here. So let me just make it easy for you. Let me put some comments. So since cost of equity of 14% of a proxy is given, the Miller and Modigliani formula should be used to calculate the cost of equity on gear as follows, as shown below. Okay. Therefore, I would then say using cost Miller and Modigliani, cost of equity of a gear will be equal to cost of equity on gear plus, open a bracket, cost of equity on gear minus cost of debt, all right, multiply by debt value, multiply by 1 minus tax, divide by equity value. So this is the Miller and Modigliani formula of cost of equity. So we are given 14%. Forget about the percentage on the 14. Okay, just write 14. Here is 14. Then cost of equity on gear is what we are looking for. We don't have it yet. So minus cost of debt. Your KD, which is cost of debt, represent the interest rates on the debt of the proxy company. So I will go back to the information I have on the proxy company. You are told that CL has 15 million shares in Ijo, trading at 2 naira 53 kobo. That's the market price of the ordinary share. That's the share price. And 40 million bonds trading at 94.88 per 100 naira. So examiner has given me proxy information. There is a bond of 40 million naira. So this bond is supposed to come with a coupon rate. The coupon rate is not given in the question. The coupon rate is the interest rate of the bond of 40 million naira. Since the interest rate is not given to you, so anytime that you are not given interest rates of a debt capital, then you are going to assume the risk-free rate of return as the cost of debt. So in this case, since we are not given the KD, then we are going to use the risk-free rate of return of 4.5%. Then multiply by debt value. I need to go and calculate debt value and equity value of the proxy company. So that will take me to working number 8 or 9. So, okay, this should take working number 9. Let me use this space. Okay, number 9. So which is the market value? I want to calculate market value of the proxy. Of Cantona. So value of equity, market value of equity. Let me write it because we are using E. E is the market value of equity, which is number of shares multiplied by share price. So E will then be equal to the number of shares according to the question is 15 million shares at what price? At 2 naira 53 kobo. So 15 million, our figures are in thousands. So multiply by 2.53. So this is equal to 15,000 multiplied by 2.53 equal to 37950. 37950. Then the value of the debt is bond of 40 million naira. So to get the market value of the bond is nominal value multiplied by X int price. Okay, then divide by 100 naira. So in this case, the value of the bond, which is 40 million nominal value, 40 million, figures are in thousands, so we'll put it 40,000. Then multiply by X int price. Examiner told us that's 94.88. Is it 94.88? Yes, 94.88, then divide by 100 naira. So what do you have there? 40,000 multiplied by 0.9488. That's 37,952. 37,952. So this represents the value of equity and debt. So let's go and put it there in the formula. So debt is 37,952 into tax rate of the proxy company is 28%. So we are supposed to account for 72%. Divided by value of equity is 37,950. So I would then say 14 equal to KEU plus KEU minus 4.5 multiplied by, what do you have there? Multiply by 0.72 equal, then divide by 37,950 equal, that's 0.72 multiplied by 0.72. So let's expand this. I would then say 14 equal to KEU plus 0.72 KEU minus 0.72 multiplied by 4.5. That's 3.24. 3.24. So you collect like terms. So here will be 1.72 KEU. KEU, this one is 1 plus 0.72. That will be 1.72 KEU. KEU equal to 14 minus 3.24. Therefore, KEU is equal to, sorry, it has to be plus. So that's 0.24 divided by 1.72. So what do you have there? 17.24 divided by 1.72. That's approximately 10%. So our cost of equity loan here is 10%. So that's it. I would then come here 10%. So K at 10%. I can also use beta to get the same answer, but I don't want to go through that route now. So here will be 1, here will be 0.909, 0.826, 0.751, 0.683. Of course, working number 8, I think, yeah. So at this point, I need to get my present value. Here is 21731. Okay, this is the PV, then this base case MPV. Okay. So I would then say 696 multiply, sorry, 696 multiplied by 0.909 equal 633. 633. Next one, 1558 multiplied by 0.826 equal 1287. Okay, the next one, 2127 multiplied by 0.751 equal 1597. Okay, then the last one, 258 multiplied by 0.683 equal 193. Therefore, base case MPV is equal to 193 plus 1597 plus 1287 plus 633 minus 21731 equal 1086. Okay, equal 1086. So let's confirm the accuracy of our numbers. Something is not tying up. It's supposed to be 1060. But here I'm having 1086. So it's supposed to be 1060. Let's check. I solved the same question on Sunday. Let's check. Guys, are you with me?
Yes.
Let's confirm the accuracy of the numbers. Something is missing.
Check. The first year 0.
Year 0.
Okay, no, year 0 is correct. Year 0 is correct. No, it's okay.
Let me check this last one, which is 3162. Before that, 10962. Sorry. 10962 minus 6064 minus 1736 equal 3162 multiplied by 0.25 equal 791. Okay, so 3162 minus 791 plus 243 plus 24,000 equal 26614. Okay, this is not correct. It's not 28258. Supposed to be 26614. So the last one is not correct. 26614. So multiply by 0.683 equal to 17,177. So here's supposed to be 17,177. Okay. Sorry,
No, I'm not
18,177.
getting this 26614. This last number is not one, the working capital is not 1644.
Yes. 1644. 312. Let's do it again. 3162. Sorry. 3162 minus 791 equal 10 plus 243 plus 24,000. Okay. Equal. Oh, okay. Plus I didn't add 1644. Yeah, it's correct. It's true. It's 28,258. 28,658. 28,658. Okay. So that means what was here before was multiply by 0.683. That's 19.3. So confirm where the difference is coming from. It's supposed to be 1060, not 1088, 1086. Something is not right.
Since we're running out of time, can we just write the base case MPV as the correct figure? Then we'll go and, as part of the assignment, we can now start checking where it's coming from, because I'm looking at the time. Time is
right?
wasting.
Yeah, it's okay. So let's assume what we have at 1086 is the right number. So let's move to the next one, which is to calculate the PV of financing effects. So what did I call this one? So let's say this is step one.
You said the correct figure ought to have been what? 1060?
1060, yes, 1060. Yeah. Okay. Let me even check this
I
here
was suggesting that you should use your 1060 to continue.
Yes, let's even check the accuracy of the year two. Let's check that year two again. Let me do the year two calculation from the profits from the beginning. That year two, 731. Okay. 731. Let me even do it here too. I have 1918.
It's correct.
It's correct. 1918 multiplied by 0.25 equal.
It's correct. So can you
480.
check the working capital I used for year two?
Okay.
Check
It's
your
possible.
workings. Yes, working
Okay.
capital.
Working capital for year two. Working capital for year two. Oh, it's 324. That's where the problem is coming from. It's 324. 324 working capital. Working capital. Year two. Something is missing. Year two supposed to be 364. Let me see again. Let's pick the number so that we can.
That's 15% of the sales.
So 324, 465. 324, 465, then 124. That's the order. 324, 465, 124. 324. Okay. 465. I misplaced them. It's a transposition error. This is supposed to be 465. Then this one's supposed to be 124. Okay. So let's do the net cash flow now. So this will then be 1918 minus 480 plus 244 minus 465 equal to 1217. This is supposed to be 1217. Multiply by 0.826 equal, that's 1,005. Okay, 1,005. Then the third year, 3131 minus 783 plus 244 minus 124 equal 2468. Here supposed to be 2468. Then multiply by 0.751 equal 1853. There is 1853. So 19,300 plus 1853 plus 1,005 plus 633 equal, then minus 21,731 equal 1060. Yeah. So that's that. So I can say the base case NPV is 1,060,000 naira. Okay, so the second part, which is PV of financing effects, calculating the PV of financing effects. What are you supposed to do? 3 stages. You need to calculate the PV of cash saved, sorry, PV of issue cost. Let's start from there. PV of issue cost. In this question, issue cost is not separated into debt and equity. It's purely debt, and then of course purely debt. So the first thing you need to do is to establish whether you want to use the normal borrowing rates as a discount rate for financing effect cash flow, or you want to use the risk-free rate of return. Therefore, and I advise you to always use the normal borrowing rate because it will always be higher than the risk-free rate of return. Therefore, I can then say normal borrowing rates, NBR, normal borrowing rates, is equal to, I will go to the question, what's the normal borrowing rate? That is the interest rate of Alcantara. So according to the question, in the first paragraph, in the second paragraph, you are told that the government is excited about the project and has offered a subsidized loans of 80% of the investment fund needed at the beginning of the project, which means that the gross finance required is 80% of a subsidized loan is 80% of the gross finance required. So the balance of 20% is through normal borrowing. So, and the interest rates on the subsidized loan, examiner told you that it's at a rate of 200 basis points, which is 2% below the normal, below the AS borrowing rate. The AS borrowing rate is not given to you. You are told that currently a head can borrow at 300 basis points above the 5 years government debt yield rate. So 300 basis points above the risk-free rate of return. Therefore, what am I supposed to do? I will say 300 basis points. Let me rewrite that. 300 basis points is the same thing as 300. And when you are given the basis point, just divide it by 100. That's 3% above plus the risk-free rate of return according to the question. You are told that in the last paragraph, in the last bullet points, you are told that the 5-year government debt yield is currently estimated at 4.5%. So that's the risk-free rate of return. Remember, risk-free rate of return is the rate of return associated with government security. So government debt is estimated at 4.5%. That's the risk-free rate. Here is 4.5%. Therefore, the normal borrowing rate will then be 3.3% plus 4.5%. which is equal to 7.5%. That's that. Then, of course, another thing you need to ascertain from the beginning is whether you want to use the net finance required or the gross finance required. So I also advise you to always use the gross finance required if, of course, examiner will never tell you to use either gross or net, but always use the gross. So the net finance required, for example, net finance required is equal to the initial outlay plus the working capital, so which is equal to 21,731. We've already calculated that. Therefore, the gross finance required will then be equal to the net finance required divided by 1 minus issue cost rates. Issue cost rate, which is equal to 21,731 divided by 1 minus the issue cost rate. According to the question, what do we have? So we are told that issue costs are 4% of the gross finance required, okay? So which is 0.04. So what do you have here? 21,731 divided by 0.96 equal to 22,636. Okay, 22,636 is the gross finance required. At this point, I can then calculate my present value of issue cost. So the PV of issue cost, that will be my working number. Okay. Okay, let's just continue. So the PV of issue cost, that will be 2A.
9.
So I want to continue the PV of that issue cost. Sorry, of the financing effect. So in this case, when you want to calculate the issue cost or the PV of issue cost, the first thing you are going to do is to determine the amount attributable to issue cost. That is, issue cost amount will then be equal to the gross finance required multiplied by issue cost rates, which is equal to the gross finance is 22,636 multiplied by 4%. So what do you have here? Multiplied by 0.04. That's 905. 905 is the issue cost amount. Therefore, the PV of issue cost amounts in year 0 will then be equal to the issue cost amount of 905 multiplied by discount factor at year 1. We have assumed the cost of borrowing as our discount rate to be 7.5%. Okay, that's our discount rate to be 7.5%. Therefore, in year 0, the discount rate at year 0, discounting factor at year 0 is equal to 1. So this will give me 905. It's a cash outflow. That's the present value of issue cost in year 0. Then you are going to calculate the PV of issue cost amount, tax saved, PV of tax saved of issue cost amount in year 1 only. PV of tax relieved on issue cost amount in year 1 only. Therefore, here will be, of course, it will be the issue cost amounts. I've already given you the formula. Don't let me be wasting time. So that will be issue cost amount of 905 multiplied by discount factor of year 1 at 7.5%. Okay, so this discount factor of year 1, 1.075 raised to power 1 minus equal, that's 0.930, 0.930. So multiply that with 905. 905 multiplied by 0.930 equal to 482. Sorry, 840.
Please just clarify, how did we get this 0.930 again?
It's discount factor now.
Okay, of the 7.5. Okay.
Yes, so you just do, 1 plus r raised to power minus
it's okay.
1.
No, it's fine.
So 1 point, let me do it again. Let me just do it again to confirm. 7.5 divided by 100.
It's correct. It's correct, yeah.
Okay, plus 1. Yeah, I just want to do the second, use second height. That's 0.90. Okay. So multiply by, sorry, I said tax saved. I have not multiplied with company tax rates. Company tax rate, for the company tax rate for Alcantara is 25%. So multiply by 25%. Okay. So I have 905 multiplied by 0.930 multiplied by 0.25 equal. That's 210. Here is 210. So when you less, that will give me 905. 905 minus 210 equal 965. Sorry, 695. So this is the PV of issue cost. So that's that. Then I will go to 2B. 2B, I want to calculate PV of subsidized loan. So PV of net subsidy. Okay, PV of net subsidy. This will be calculated as, the first thing you need to do under PV of net subsidy is to determine the subsidy amount. Okay, subsidy amount is equal to gross finance required multiplied by the proportion of subsidy, proportion of subsidy, okay, which is equal to 22636. Examiner has told us that 80% of the gross finance required is attributable to subsidized loan. Therefore, this will be equal to 22636 multiplied by 0.8. That's 18,000.
109.
109, okay, 109. So that is the amount attributable to subsidized loan. That means the balance of 20% is through normal borrowing. 18,109, happy? Yeah, that's it. Okay, let me rewrite that. So the next step is for me to calculate savings on subsidy in percentage, SOS in percentage, which is equal to the savings on subsidy is subsidy amount. Before that, savings on subsidy is normal borrowing rates minus interest rate on subsidized loan. The normal borrowing rate is 7.5%, okay? Minus savings on subsidy, interest rate on subsidy. Let's go to where you have subsidized loan. According to the question, you are told that the interest rate on the subsidized loan is 200 basis points below the company's normal borrowing rates, okay? So the normal borrowing rate is 7.5%, so 200% below 7.5% will give off 5.5%. So let's do the working first. Under the normal borrowing rates, let me come here. Normal borrowing rates, that's working about 10. Normal borrowing rates, NBR. So the normal borrowing rates, according to the question, we are told it is 200 basis points below the normal borrowing rates. Normal borrowing rates is 7.5% minus, because it is below, so minus 200 basis points. Okay, this will give me 7.5 minus 2%, which is equal to 5.5%. So that's the subsidy rates. So with this, I can then say, so minus 5.5%, which is equal to savings of 2%. So after that, we need to calculate net subsidy. Okay, net subsidy, NS. And you know, NS is equal to the subsidy amount multiplied by savings on subsidy multiplied by 1 minus tax. All right. Okay. So subsidy amount is 18,109 multiplied by 2%. Savings on subsidy multiplied by 1 minus tax is 0.75. So what do we have there? So 18,109 multiplied by 0.02 multiplied by 0.75 equal, that's 272. Here is 272. So that's the savings, that's the net subsidy. After the net subsidy, the next thing we need to do is to calculate the PV of net subsidy. So PV of net subsidy. So PV will then be equal to net subsidy multiplied by annuity factor. So net subsidy is 272. So let's go and calculate annuity factor.
1 plus
Annuity factor at 7.5%.
5%. 0.05.
Annuity factor.
1 plus 0.075.
AF equal to 1 minus 1 plus R raised to power minus n, all divided by R. So here is 1 minus 1.075 raised to power minus 4. The useful life is 4. Divided by 0.075. So what do you have there?
3.3.
3 point what?
3.349.
3.349. So okay, that's that. So let's go up there. 3.349 is the annuity factor. 3.349. So multiply by 3.349. So what do you have there? 272. 272 multiplied by 3.349. That's 911. 911. So that's, we are done with the PV of net subsidy. Finally, we need to calculate, that will be, what is this one? That's 2B. So 2C now. 2C. So we know to calculate PV of tax saved on interest. Okay, PV of tax saved on interest. Let me manage this space so that I don't go to another page again. So PV on tax saved, the first thing you need to do is to accumulate all interest elements. I said accumulate all interests. What do I mean by that? I will say interest on borrowing equal to how much are we borrowing out of the gross finance required of 22,636. So 20% is for true normal borrowing because 80% is true subsidized loan. So 20% will be for normal borrowing. Then the interest rate on normal borrowing is 7.5%. So what do we have here? So I carry my calculator. 22636, 22636 multiply, sorry, that's an error. 22636 multiplied by 0.2 multiplied by 0.075 equal, that's 340. Here is 340. Then interest expense on subsidy equal to, the proportion of subsidy is 18, or you can just say 22,636. Proportion of subsidy is 80%. Then multiply by interest rates on subsidized loan is 5.5%. So What do you have here? 22,636 multiplied by 0.8 multiplied by 0.055. Okay, that's 996.
996.
Here is 996. When you add it together, that's 1336. This represents the total interest. That's total interest. Okay, now that you have the total interest, the second step is for you to, I don't want to go to, I still need more space. So the second step is for you to determine the tax saved on interest. So tax saved on interest, which is equal to, tax saved on interest is total interest multiplied by company tax rates. Total interest is 1336 multiplied by company tax rate is 25%. So what do you have here? 336 multiplied by 0.25 equal, that's 334. 334 is it tax saved on interest. Finally, you calculate the PV of tax saved, which is equal to the tax saved multiplied by annuity factor. So tax saved is 334 multiplied by 3 points. What do you call this in
349.
annuity factor? 349. 349. What do we have here? 334 multiplied by 3.349 equal to 1119. Okay, that's a PV of tax saved on interest. So finally, all I need to do now is to calculate the PV of financing effects. Okay, so that will be 2, is it 2C or 2D? Yes, 2D. I would then say PV of financing effects, cash flow. So the PV of financing effect cash flow, my figures are in thousands. So I will pick PV of issue cost, which is 905? No, 695. 695 negative. Let me go and confirm. That's 2A. 2A, yes, 695. Then PV of subsidized loan is 272. Sorry, it's 911. Okay, 911 PV of net subsidy. 911, then PV of tax saved on interest, which is 1119. Okay, what do you have here? Here will be equal to 1,119 plus 911 minus 695 equal 1335. So this represents the PV of financing effects. Now that you have the PV of financing effects, finally, you need to calculate the adjusted present value. Okay, and I don't have a space. I need to go after the working. I did not estimate sufficient space. So let's go to the last one, which is the APV now. That's step 3. Step 3 is to calculate the APV. Let me use this space. So calculating adjusted present value. So all I need to do, my figures are in thousands. So I would then say base case NPV. My base case NPV is 1060. Then I will add PV of financing effects, which is 133 watts. PV of financing 1335. So this should give me 2395. That's my APV. The examiner is asking you to evaluate on financial grant. Okay, evaluate on financial grant whether AS should proceed with the project. Since our APV is positive, I would then say the project is financially viable considering the positive APV of 2,395,000 naira. Therefore, the project should be undertaken. The projects should be undertaken. Then you now state all your assumptions. Okay, state your assumption from the cash flow, talk about cash flow, talk about cost of capital, talk about inflation, talk about some costs, the feasibility study cost of 5 million naira. Talk about all those things. So well, if you do all of this, you are good to go. So that's end of the question. In the B part, you have to discuss the appropriateness of the evaluation method used and explain the assumption made in part C. Quickly, let me show you. All you need to do is to just explain the meaning of adjusted present value. That's what the examiner is asking you. Just explain the meaning of adjusted present value and how you think it is more appropriate in the evaluation of this kind of project. Let me show you what I have. Let me just use my golden book to explain that, to just show you. Where are we? Let me share my screen. Okay. Let me see. Yes. So you can see from here. So the APV method is a technique. So you know all of this. You know all of this. I've already explained that earlier today. Under the assumptions, these are the things I'm talking about. So you talk about cash flow, talk about discount rates that you use for the financing effects. So you talk about the gross finance required, talk about working capital. All these things, just mention them in your assumptions because you cannot hang your full mark if you don't state your assumption. You have to state your assumption. We also talk about the fixed overhead of 60%, which represent the centrally allocated cost. So let's talk about all of these issues. Then the ethical issue in the C part. What are the ethical issues? Let me just mention a few of them. Okay, health and safety. So you need to talk about health, and when you talk about ethical impact of a project, you talk about safety. Okay, health and safety of the employees. All right, that the employees and the public should be protected from danger, which include working condition, effective employment law, and the safety, product safety. So all of this, just go to the in the golden book, you see. So for some of you that have access to it, so you read all of this. Then we go to the past question. You also see the although my approach in solving the APV is slightly different because this one is more detailed relative to what you have in the Pathfinder. So, but again, it's the same answer, but you will understand better. So you can go to the to get all of these ethical issues and all of that. Because of time, I don't want to extend beyond what we have. It's already 11 o'clock. So I don't want to, yes, that will be that. Take your time to review all of this. Take your time to review all of this. Yes, that's that. That's that. So Let me know if you have any question for me so that we can close the class for today. Any question? So in the absence of no further question, thank you everyone for your patience. I will see you next time. In our next class, by the grace of God, we are going to be having capital rationing. That is very straightforward. It's a very straightforward topic. It's just like linear programming, but it's very straightforward. So by the grace of God, we are going to start that next in our next class. Thank you guys once again. I will see you next time by the grace of God. Good night.